Good afternoon, everyone. I want to begin by talking about dramatic changes. Many of you would have learned about Metamorphosis when you were at school, the most well-known example of which is the life cycle of butterflies. To start the process, a caterpillar's body releases hormones which would trigger drastic changes to its cells and even some behavioral changes like spinning the cocoon that protects it during the transformation. When metamorphosis is complete, the caterpillar, which once was an unsightly crawling worm, transforms into a beautiful flying insect. The FinTech industry is undergoing a kind of metamorphosis. Just like the hormones that trigger the metamorphosis of the caterpillar, technology has triggered the transformation of the financial industry. It has allowed firms to introduce a wide variety of innovative products and services which have enhanced customer experience and helped achieve better investor outcome. For instance, if you want to open an account with a securities broker, you can now do it remotely from Hong Kong or anywhere overseas. You can now use instant messaging apps to place orders with your stockbroker or buy an investment products through a mobile app on your smartphone. Our latest survey on the sale of investment products in Hong Kong found that about 54% of clients had bought funds from online platforms last year, and online sales accounted for about 1/5 of all the funds sold, and that's a big increase from what it was before. The number of SFC licensed corporations selling funds online more than doubled last year. In fact, the distribution of investment funds is one area where the pandemic and work from home really accelerated the use of technology. The use of technology can also lower costs of consumers. In the past, investors needed to pay substantial fees for financial advice. With the advent of technology, these services can now be automated and provided at a lower cost. In Hong Kong, we licensed several digital wealth management advisory platforms, or what we call Robo Advices, and are now considering a few more applications. These services can help retail investors diversify their portfolios more efficiently and more affordably. Here, I want to stress that for all the examples I've just mentioned, the SFC has provided clear guidance on how our regulatory principles will apply in a digital environment. This brings me to virtual assets. Amongst all the changes in the financial industry, virtual assets is the one innovation which has brought about a paradigm shift and what we might even call a metamorphosis. To start with, it might be useful to recap how we got here in the first place. The virtual asset space has evolved dramatically over the span of just a few years. In metamorphic terms, there have been many butterfly cycles. Virtual assets first appeared on the regulatory radar around 2017 when initial con offerings were prevalent. Many so-called offerings were actually scams which posed serious consumer protection issues. At that time, international regulatory bodies such as the Financial Stability Board declared that virtual assets did not have any intrinsic value at all. The crypto world was seen to be of marginal importance to the global financial system, a fad that would eventually fade away. Those were the early days. Financial regulators were reluctant to put this under their regulatory net, as that may provide virtual assets with the legitimacy. Another challenge was where the line was drawn around regulatory perimeter. Bitcoins do not fit into the definitions of securities or funds or investment contracts and therefore fall outside the perimeter in most jurisdictions. But it was clear that the anonymity common in trading these assets raises serious issues around money laundering and terrorist financing. Not only that, but trading on unregulated virtual assets platforms raises serious market integrity and consumer protection issues related to cybersecurity, market manipulation, and safe custody of assets. Financial regulators were struggling with these issues. How do virtual assets and their activities fit into the regulatory net? Should they or should they not be regulated? At the time, the responses from regulators were diverse. At one end of the spectrum, a few opted for total ban. At the other end, some jurisdictions fully embraced crypto assets. Thinking that regulation might stymie in innovation, they opted for an extremely light touch approach. Most jurisdictions fell in between, adopting a wait-and-see attitude. The SFC was one of the early pioneers in coming up with a comprehensive policy response. We decided that we cannot rely on a narrow interpretation of our remit and took the view that the whole crypto world was unregulated, and most we could do is just to warn the investors of the risk. If, in reality, investors are left unprotected as crypto activities thrive, then maintaining the status quo may not be an option. This led us to announce a regulatory regime for virtual assets at FinTech Week in 2018. It included new requirements for funds supervised by SFC, which intend to invest more than 10% of a mixed portfolio in virtual assets. This is irrespective of whether the virtual assets amount to securities or futures contracts, which already fall under the perimeter of our regulation. Another requirement was that only professional investors should be allowed to participate, and we provided specific guidance on the distribution of funds with crypto exposures. We also announced that we would explore a conceptual framework for centralized virtual asset platform operators to opt in for our regulation. A year later, that is in 2019, we formally launched this framework, publishing regulatory requirements which applied the principle of same business, same risk, same rules. What this means is that the regulatory requirements for virtual assets platform operators draw heavily on the standards we expect of conventional securities brokers and automated trading platforms. Although they have been adapted somewhat to deal with specifically with crypto technology, in addition, we required that licensed platforms should only provide services to PIs for the time being. The framework covers all the key investor protection concerns, including safe custody of assets, know your client requirements, anti-money laundering, market manipulation, risk management, etc. The requirements are the same as that of automated trading platforms and dark pools that we currently supervise. But why an opt-in approach? Our view back then was that it was far too early to change our laws to specifically cover the crypto world, which moves too fast to be pinned down by a bespoke legal framework. This approach has allowed us to protect investors, watch the space evolve, and gain supervisory experience to help us decide how the wider virtual asset universe should be regulated in future. 3 years have gone by since the inception of the idea, and we have put in place a regulatory framework for virtual assets. We licensed one virtual asset trading platform, and applications from several others are under consideration. We also approved a number of virtual assets fund managers and are considering several more. Of course, some of the crypto world would say 3 years is an eternity, but there is no denying that the regulatory landscape has gone through a dramatic change in a short period of time. First, in recognition of the fact that virtual assets are going to stay, most regulators around the world have brought them under some form of regulation, at the very least, some kind of anti-money laundering regime. The Financial Action Task Force, FATF, made a strong global push towards greater regulation of the virtual asset space. It enhanced the standards to require jurisdictions to license or register virtual asset service providers and subject them to the same range of AML obligations that apply to financial institutions. That is, again, same business, same risk, same rule. To comply with these standards, The Hong Kong government concluded earlier this year that the local AML law should be amended to mandate all centralized virtual assets trading platforms to be licensed by SFC. Second, regulators are paying more attention to market integrity and investor protection concerns. The International Organization of Securities Commission, that is IOSCO, has suggested specific areas to consider while regulating virtual assets trading platform. You may not be surprised to hear that these are the same areas that SFC looks at under our existing regime. Just recently, Gary Gensler of the US SEC said publicly that he has made it a priority to focus on regulating crypto trading platforms. The third area of regulatory concern is stablecoins. This follows an explosion of interest in DM, previously known as Libra. In contrast to virtual assets like Bitcoin, which has no intrinsic value and is extremely volatile, stablecoins are relatively stable, and this is a key feature of the pitch that they can make cross-border payments far less expensive. The BIS Committee on Payments and Market Infrastructure, that is the CPMI IOSCO, recently published a joint report which advocated for regulating stablecoin arrangements as a financial market infrastructure similar to traditional payment, clearing, and settlement system. The report also urged regulators to consider the systemic importance of stablecoin arrangements. These developments in the international regulatory scene underscore that the same business, same risk, same rules approach we adopted back in 2018 is the right way to go. Of course, there have also been significant changes in the market landscape over the past 3 years. Virtual assets are edging towards mainstream finance. A lot more different types of VA investment funds products are available, and conventional exchanges overseas now offer crypto exchange traded funds. Financial institutions are moving towards offering these products and services. In recent months, we have received a number of inquiries from financial institutions eager to offer virtual assets to their private bank clients or professional investors. These questions involve complicated issues because the regulatory landscape is still very uneven. For instance, some licensed firms wish to provide cryptocurrency trading services to clients either by acting as an introducing agent or through an omnibus account arrangement open at a virtual asset platform. The question under consideration is, do these firms expose their clients to undue risks of the virtual assets platforms that are unregulated or regulated for limited purposes? Also, under an omnibus account arrangement, the firm will directly onboard the clients and trade for them, with some of the regulatory obligations typically imposed on the licensed VA platform applied to these licensed firms also. Do we expect the firm to conduct a knowledge assessment before providing VA trading services to their clients? Distribution of VA-related investment products is another area of interest. We already have guidance on the distribution of investment funds with crypto exposures. But what about other products, such as crypto-related ETFs traded on conventional exchanges? Should we allow retail investors to access these products through online brokers? If so, would there be additional requirements or risk disclosures? This is just a glimpse of the regulatory issues involved. We are now reviewing the regulatory regime for virtual assets we introduced 3 years ago to see if it is still fit for purpose and whether any modifications are required. We are in close dialogue with the Hong Kong Monetary Authority with a view to issuing a joint circular after the review. One can expect that it would incorporate the same business, same risk, same rules principle in a proportionate manner. Here in Hong Kong, we see our job as providing regulatory clarity to support the healthy development of this space. A clear regulatory environment is just as important as the cocoon in Metamorphosis. Some may say that the cocoon is limiting innovation and development, but like all good regulation, it will help FinTech firms and their services to incubate so that they can operate within a secure environment for sufficient trust to be built from investors for this business to be scaled and provided to the wider public. To conclude, I want to emphasize that we will maintain our practical approach to provide a well-defined regulatory environment which fosters innovation, development, and investor protection. We look forward to continuing this journey with all of you and to seeing more beautiful butterflies from the FinTech sector complete their transformation and move from the fringe to the financial industry mainstream.